Insurance, Lawrence from H Capital Insurance. Thanks for the presentation. I have two questions. This one, for all the returns calculation, do you incorporate the dividends, and do you also have a dividend reinvestment? And what sort of assumption you use in there? For the second question, on page 26, you have this control risk 20% strategy. And how do you incorporate slippage cost into the strategy? Because in real life, when vol spikes, it's not easy to deleverage the position at favorable prices. So do you actually incorporate the slippage cost?
Well, that's a couple of very good and tough questions, I guess. So in terms of looking at the cost, those numbers those are theoretical numbers, so they don't include things like the transaction cost, market impact, or slippage. However, what we do with every one of these concepts, and I haven't shown this here, and I'm happy to share this with you afterwards, is we do look at the transaction cost optimization. So obviously, if I'm showing here a benefit in return, that return benefit must not be eaten up by trading or slippage costs, right? So there's a trade-off between how often do I rebalance this strategy versus how much return, how much cost do I have. So the optimal way theoretically optimal way of getting most return and risk reduction out of it is to rebalance daily. To just adjust the risk level on a daily basis. However, that's not really feasible. So we do look at where's the optimal point for rebalancing. So here we would actually look at on a regular basis, we would only rebalance monthly, unless there's a huge volatility spike, of course, when there's an extraordinary adjustment. Sometimes even the monthly adjustment does not have to be done if the level is still pretty much at the same. So we do actually end up rebalancing not more than once a month in these concepts, which is important. But we can actually also disclose the cost for slippage. Or well, slippage cost is somewhat difficult to estimate, but you can make some assumptions. And I have to say, I hope it says it here somewhere. At least, I mean, I'm comparing apples with apples. I can confirm that because both the base index and the strategy index do the same thing. I believe that they're on a net return basis. So that means that dividend has been reinvested on a tax-adjusted level.
Sure. Right. Thanks.
Thank you.
Hi, my name is Brendan. I was just curious how, your process of thinking when you're coming up with an index, like a broad index for Korea, how do you actually choose which equities to include? What's the framework that you have? Like, what are factors that you look at?
Okay, sure. That's a good question. So ultimately, in index design, you have a number of options. Usually, it's a set of steps. So you start with defining your base universe. Now, we've already done that and said we'll look at Korea, and then you start selecting and/or filtering. So usually, you would filter out a whole bunch of stocks based on certain criteria. So, and what we do is we obviously have a standard that we use at STOXX globally for all of our standard indices, and then we have different methodologies that we can apply in order to either cater for individual market circumstances or cater for individual demand from clients. Now, what we would naturally do is, first of all, start with a minimum liquidity. So we would say if this index is supposed to be traded by anybody or used as an investment product, which is primarily what we do, so we would say, let's say there must be a minimum trading volume of, depending on what type of product it is, but let's say $1 million would be an absolute minimum a day. But we could move that up to as much as 20 million USD or something on a daily basis in order to really have a very highly liquid product. So with that, you would cut off all the more illiquid stocks. Then the next step would naturally be to define some sort of selection criteria. Now, the traditional way is using market cap or free float market cap. So just take the largest companies, whatever the largest 50, largest 20, largest 100 by market cap. But there's more sophisticated methods. I mean, dividend indices would use dividend yield to select the components. Fundamental indices may use some more offline, not so market-related number to select. So ultimately, you can choose your attribute and say, I want to select by that. And when we look at the sustainability indices that I mentioned last, the selection criteria is actually the score on the sustainability score. So when we work with clients, we try to understand best what they are actually trying to achieve, and then we try and set the filters in such a way that it fits that. And we also do a lot of work with regards to thematic investing, where you would actually select the companies in your index by their exposure to certain markets or industries and things like that. So in our internal toolkit that we use to put together indices, there's one area that is marked selection rules, and where we would actually go through and define a number of selection rules. And I mean, but to make a point here that the standard would be to use free float market cap to select the components. That would always be the starting point to look at something.
Hi, my name is Tom here. My question is, in an environment where inflation is staying elevated for an extended period of time, do the indices that you construct take into account the inflation when measuring it?
The inflation?
Yes.
No, they don't. And they just measure the market prices, and we don't really have an inflation component in the indices. Ultimately, it's a very interesting topic in terms of product development to build indices that are inflation resistant. And that's something that has been, when talk about inflation is coming up, there has been talk about what type of index product can I generate that is most resistant to inflation. But ultimately, the index measures some sort of cash market or some underlying market and doesn't consider inflation.
My understanding is in the bonds market, there are certain indexes that have built-in inflation adjustments. I'm not sure whether in terms of the equities indices, whether is the development going towards incorporating inflation into those indices.
In the fixed income market, you have the respective instruments with inflation-linked bonds that you can use to actually generate these indices that have that inflation component. I may be ignorant, but I'm not really familiar with a similar construct on the equity side that would actually allow any instrument to include that. But if anybody knows of it, I'd be interested to learn about it.
Okay. Oh, you have one more question? Okay, start.
Scott from Deutsche Bank. I can imagine if you're working with a client that you sort of, to find a university, you choose a couple of stocks, and you say, well, that's performance is not quite right, let's choose another stock that's no good. Oh, this one is good. So in essence, you're kind of data mining the universe to get something that looks good, but is really not necessarily going to perform. Have you got any sort of processes to manage that, or how do you control for that risk that the clients end up disappointed with, and getting the process a little more rigorous?
Sure. I mean, I think that's the forging of good backtestings is one of the downfalls of our industry in general, because it tends to be relatively easy to put together an index that has performed well on a backtesting with hindsight about how specific stocks have performed. So our ground rules for creating an index more or less in conjunction with the client is we actually offer a couple of different services. One is a customized service where we actually just do the calculation, and whatever stock selection is done is by the client is not within our responsibility. We don't apply any of our methods to it, and we wouldn't actually put our brand on anything like that. And we see ourselves as a calculation provider only, so we don't have so much view on that. But in terms of it has our brand on it, and we actually promote it as a proper index produced by STOXX. We have some very strict rules, and one of those is it needs to be fully rule-based. And there's no way that there's a judgment call on an individual stock or not. So there will be, what we will try out is different selection criteria, maybe also different parameterizations for specific strategies. So if you take this risk control strategy, we don't really say 20% is the right way or 15%. We just sort of offer the different ones. But the important thing is that once you put out the strategy, you've got to stick to it. You can't just go and change the selection criteria because you don't like it anymore half a year later. And of course, sustainable development in the sense that I would always require from any kind of, from any of our own indices that there is some form of fundamental reason why we do that strategy. And just writing down there as a reasoning, well, it worked well in the past, that should not be something that an index provider should promote. But if somebody tells me, well, we believe that stocks with a high dividend yield outperform because they tend to be undervalued in solid companies, and then that's something where you can actually do a back testing and try and determine what's the best way of selecting those components and come up with something. And if that works or not in the future probably depends on how valid the initial hypothesis is. But there needs to be some sort of fundamental reason for doing that, and it mustn't just be, oh well, this worked really well.